John Stanfield, General Manager of the Horizon Credit Union at 97.3 ABC Illawarra. Who do you think is more likely to pass on the full rate cut?
Well, history tells that the mutual organisations, the building societies and the credit unions have been a lot more sympathetic to their borrowers in passing on RBA cuts in full. And, you know, whether or not that happens again, time will tell. But, look, I think every organisation is obviously making its own decision about what it needs to do, and everyone's circumstances are different. And what has changed, particularly over the last few years, has been the cost of deposits coming through, what we talk about as the cost of funding. And that's what's influencing a lot of organisations not to pass on the full rate decrease.
The banks claim that the cost of funds has risen, and so therefore they're not able to pass on the full increase. Can you explain that in simple terms, what that means, and whether that is broadly true?
Sure. Well, the banking model, as we all know, is relatively simple. You borrow from one group of customers who have deposits, and you lend it out at a higher rate to people who require loans. Now, what banks have done traditionally over the years is not just borrow from retail customers, the mums and dads of the world, but they actually go offshore or they borrow from other institutions, what are basically called wholesale borrowings. Now, up to the GFC, up to 3 or 4 years ago, banks were able to borrow in the wholesale market very cheaply, around about what the Reserve Bank rate currently would be at the time.
What is that wholesale market?
Basically from other banks, generally, superannuation funds, could be international investors.
Okay, so they could borrow on this market at about exactly that rate that the Reserve Bank set. Why has that?
Exactly.
But approximately, okay.
Yes.
Why has that risen lately? What's happened to the market?
Well, it's not just lately. It's basically something that started through the GFC period, where all of a sudden everybody got very nervous about the financial system. So previously, where people, institutions, banks, were happy to lend freely to other institutions, suddenly started getting very nervous when they saw some of these big American banks falling over. And so they basically said, well, if we're going to lend to another institution, rather than lending it at, say, 4.5%, because of the risk factor in lending to you now, we're going to charge you 6%.
Right.
So this additional, say, 1.5% that flowed through onto the cost of that funding, all of a sudden the bank said, well, look, if that's going to cost me an extra 1.5% to borrow from a wholesale institution, I'm cheaper to go out to the mums and dads market, the retail investors, where I can borrow it from them for a cheaper rate than what I can do on the wholesale market.
But many people will say, well, once that has been factored in the first time, shouldn't it thereafter move basically broadly in line with that 0.5% of or 0.25% cut?
Well, I think there's been a catch-up process. It's taken a fair period of time, and I completely appreciate that's not necessarily reflected in some of the profit results of the big banks. But we are seeing a case in the term deposit market where, again, this is a market that the best rate used to be around about in line with what the Reserve Bank cash rate was. So up until yesterday, 4.25%. If you're investing in the term deposit market, the best rate you could get at the moment, or up until yesterday, was around about 5.5%, maybe a little bit more. So there's a differential of about 1.25% on what you could earn. So that's additional funding that the banks and the building societies and the credit unions are having to pay their depositors, which the big banks have been looking to reclaim from their borrowers by increasing their loan rates.
Now, the people we forget in all of this, we just immediately jump to what's happening with mortgage holders. But on the other side of the equation, as soon as the Reserve Bank lowers the interest rates, that therefore must mean that the interest rates on people with term deposits, self-funded retirees, etc., their income goes down.
It's very true, and it's always struck me as a little curious that the most of the media attention does fall upon what it means to the borrowers. But when you think about what the Reserve Bank is looking to do, is it decreases rates as a stimulus to the economy, because it thinks about all the people with mortgages that have additional money apparently to spend on other things.
Well, the implication is, John, sorry to interrupt you, that they want us to spend, not save.
That's right.
That's what interest rates going down mean.
With a lower interest rate, you might get the small businessman who's thinking about opening a factory that might not have done it, but with a lower interest rate can afford to borrow the money from the bank to go and open a factory and employ more people. And that's a stimulus effect we get through the economy. But the other side of it, of course, is, as you mentioned, there's a lot of self-funded retirees, a lot of people that rely upon their term deposits for their income. And once the Reserve Bank decreases interest rates, and if that flows through deposit rates, those people have less amount of money to spend. So that actually counteracts the impact, the stimulatory impacts from a lower interest rate.
Yeah, but the credit union, building society, or your mutual organisation funds all of its home loans from its depositors, as I understand it, largely.
Yeah, largely. It does vary a bit from institution, but normally I think across the industry it's about 95% is funded.
Yeah, so does that mean basically your home loan rates may go down a certain percentage and your term deposit rates may also go down at the same time, at about the same level?
That's probably the case. I mean, in both cases, we're obviously not market leaders as relatively small institutions. We particularly in the deposit market, our rates, we want to make them competitive, and they need to be competitive. So, we obviously benchmark against what the other rates are there in the market. But I think that's probably it won't happen overnight, but that's probably what we'll see coming through in the coming weeks. Is decreases in the deposit markets as well as decreases in the lending rates.
All right, John, always good to talk to you. Thanks very much.
Thank you, Nick.
John Stanfield, General Manager of the Horizon Credit Union at 97.3 ABC Illawarra.